Hey everybody, tonight we're diving headfirst into the thrilling world of international finance. Buckle up, because we're talking about the Brazilian real, and let me tell you, things are getting real. Awkward. The real recently took a nosedive, plummeting 4.5% against the US dollar. Now, I know what you're thinking. John, 4.5% doesn't sound that bad. But in the world of currencies, a 4.5% drop is like watching your entire retirement fund fall into a vat of fondue. Messy, upsetting, and frankly, a little cheesy. So what's got the real feeling so down in the dumps? Well, it's a cocktail of factors. We're talking foreign investors pulling out, concerns about Brazil's spending habits, and a whole host of global issues. Tonight, we're going to break down this financial fiasco into bite-sized, easily digestible chunks of information. Let's start with the elephant in the room, or should I say the jaguar in the rainforest. Foreign investors have been pulling money out of Brazil faster than you can say caipirinha, and they've been doing it in a particularly aggressive way: short selling. Short selling is a perfectly legal, if somewhat cynical, investment strategy. It's essentially betting that an asset, in this case the Brazilian real, is going to go down in value. Adding fuel to the fire are these things called CTAs, or commodity trading advisors, using algorithms to make trading decisions based on market trends. So, with foreign investors hitting the sell button and CTAs jumping on the bandwagon, the real is facing a perfect storm of downward pressure. But it's not just foreigners giving the real the side-eye. Brazil's own government is adding to the drama with some questionable fiscal decisions. Remember that saying, "You can't spend your way to prosperity"? Well, someone forgot to tell that to the Brazilian government, who've been on a bit of a spending spree lately. Now, I'm all for investing in public services and infrastructure. But when your spending outpaces your revenue, it's like trying to fill a bathtub with a thimble. Eventually, you're going to run into trouble. Investors are getting nervous about the government's ability to manage its finances, and that lack of confidence is putting even more pressure on the real. Brazil's economy, while showing some signs of life, isn't quite ready to support this level of spending. And when investors get worried, they tend to do what they do best: panic. Section 4. A world of woes, global headwinds, battering the real. As if things weren't bad enough, Brazil is also facing a whole host of global challenges that are making life difficult for the real. First up, we have rising interest rates in the United States. When US interest rates go up, it's like a giant magnet pulling investment dollars away from emerging markets like Brazil. Then there are the geopolitical tensions that seem to be brewing like a pot of bad coffee all over the world. And unfortunately for Brazil, these global headwinds are putting downward pressure on pretty much every currency out there, not just the real. Section 5. Investment Ice Age. The real's decline chills Brazilian markets. So, what does all this mean for the average Brazilian? Well, it's not exactly rainbows and sunshine, I'm afraid. The falling real is making it more expensive to import goods, which means higher prices for everything from smartphones to soybeans. And for Brazilian businesses looking to borrow money from abroad, well, let's just say it's not going to be a cheap date. When a currency is volatile, like the real is right now, investors get nervous. This lack of investment is bad news for the Brazilian economy, as it stifles growth and makes it harder for businesses to thrive. Section 6. Wizards of Wall Street weigh in. Expert opinions on the real deal. So, what's the solution to this Brazilian currency conundrum? Well, if you ask 10 economists, you're likely to get 11 different answers. But there are a few key things that most experts agree on. First, Brazil needs to get its fiscal house in order. That means reining in spending, tackling inflation, and convincing investors that the government is serious about long-term economic stability. Second, Brazil needs to find ways to attract foreign investment. That means creating a stable and predictable business environment, reducing bureaucracy, and making it easier for foreign companies to invest in Brazil. By taking steps to address its domestic challenges and make itself more attractive to foreign investment, Brazil can weather the storm and come out stronger on the other side.